Good morning, everyone. First of all, thank you very much for putting the paper on this amazing workshop. Today, I'm going to talk to you about credit card entrepreneurs. The starting point for the project is essentially the recognition that small and young businesses are essential for job creation and economic growth. In the US, businesses with less than 10 employees represent 80% of employers and approximately 13 million jobs. We also know that these are the type of businesses that contribute disproportionately to job creation and job destruction, but that they are extremely sensible to their financial environment. Now, despite their importance for the American economy, in the US, this segment of the population of firms is typically poorly monitored, meaning that if you want to have information about their activities, then you either need to rely on small-scale surveys about them, or if you're willing to wait for months or sometimes years, you can essentially think about accessing official statistics. So the situation becomes even more frustrating when thinking about their financials. Indeed, we know that the financing landscape for small businesses has changed dramatically over the last 10 to 15 years. At the same time, we have very limited tools to essentially understand how this affected their activities. In this paper, we therefore propose to essentially assemble information that allows us to monitor the economic and financial health of US small businesses and entrepreneurs. The way that we're going to do so is by essentially collaborating with Intuit QuickBooks. Intuit QuickBooks is the leading software provider for solutions to small and medium-sized firms. They allowed us, under their stewardship for data privacy, to access some novel data that we think will shed an important new insights into firm dynamics. First of all, let's note that this is a data set that will include more than 1.6 million firms in the US, with data that is not only real-time but very high quality, because we are essentially going to focus on firms that set up automatic feeds between their bank accounts and the software. That will allow us to contribute to the discussion by not only simultaneously identifying the real activity of these firms in terms of revenue and employment, but also to think at a transaction level, the level of detail about their loans, their credit cards, and their cash holdings. Okay. We are also were able, in the context of this collaboration, to combine this unique data with our own survey, in the sense that we collaborated in order to elicit from more than 5,000 Intuit firms information about the demographics of the entrepreneur, about their preferences in terms of investing and financing, and in terms of the shocks that affected their business environment. Okay? So put together, this hopefully allows us to say something important about the evolution of American entrepreneurship in the last 5 years. Our major finding in this will be that one extremely interesting highlight is going to be that we find that there is an increasing reliance of entrepreneurs on credit card financing, and that this dependence and reliance on credit card financing fundamentally changes the nature of small business dynamism. Let me walk you through the 4 main results that I hope I will have enough time, but let's make sure that the main message is in. First of all, we start in a very simple way by providing a set of stylized facts. Just plotting the data and essentially trying to understand what are the economic and financial trends. The main highlight, as I said before, is that when we started looking into the transaction level data, we discovered that payments into credit cards were substantially more important than payments into loans. Okay, so this difference not only was up to 3 times, but it also grew over the last 5 years. Then we essentially turn towards the survey in order to elicit what are the determinants that essentially trigger this dependence on credit card financing. Maybe it's just preference. Maybe it's just I like to collect points. Maybe there is no financials involved in it. But instead, what we find using the survey evidence is that, to the contrary, that it is mostly small, young, and cash-strapped firms that essentially have a higher reliance on credit cards. We also show that we need to think in corporate finance about a new pecking order, because for small firms, internal cash is followed by credit cards in the pecking order. And when it comes to mitigating shocks to their operations, credit cards is even the main adjustment variable. We then essentially turn towards the 1.6 million firms in order to look at the transaction data and simply raise a question about, well, okay, we see that credit cards are used very much by a certain fraction of the population. Does it matter for economic activity? So what we do is we essentially leverage the monetary policy tightening that started in 2022, use the differential exposure of intermediaries to that monetary policy tightening in order to obtain variation in the supply of credit card financing. By doing so, we are able to track this credit supply shock into real outcomes, and we find that on average the typical shock to credit card supply implies that the small firms will grow annually by 8 percentage points less. Okay, so it does have an important impact on firm operations. Finally, we try to put this together in terms of its aggregate implications. So we have a firm heterogeneous model in terms of productivity and securities. And we essentially try to think through the consequences of this increased reliance on credit cards. 2 things stand out. First of all, to some extent, credit cards have a benefit, which is that they increase the borrowing capacity of these small firms. So when a shock hits, they act even as a buffer. So the dip of a macro shock will be lower. However, because of the high APR, the presence of credit cards will also make the recovery more sluggish, meaning it will take more time to recover to the steady state. So when implementing this project, we followed Xavier's lead and not only looked at the data, but also talked to people. And we were very happy because we looked at the data, found this importance of credit card financing, and we tried to counter-check. So we had structured interviews with a lot of small entrepreneurs. One of them was essentially telling us, we use a credit card every single day. It's a heck of a lot easier to swipe a credit card than to get a loan. So this is Judd Robertson from Mighty Pine Heating and Air. Another one told us something similar about the importance of credit cards. However, it also transpired that they come with some costs. It's very easy to end up hitting limits, and then you're stuck with extra charges in interest month to month. Then we also found this quote. So we didn't interview Joe Gebbia from the founder of Airbnb, But he has this famous quote about the Visa financing round. So essentially they were running out of money, and so they went from Visa to MasterCard to any type of credit card financing. Okay? So let's start by just plotting the data. Here we plot the data and we make some adjustments to make it nationally representative. First, let me show you what real activity looked like of the small business segment. So on the left-hand side, you have essentially total business employment for firms with less than 10 employees. And on the right-hand side, their average monthly revenues. What you can see is, first of all, that there was a reversal of small firm dynamism. There was a rapid recovery and even a boom just after COVID, which is consistent with some evidence by Haltewanger. But coinciding with the moment of the monetary policy tightening, you see that they lost ground. They lost ground both in terms of employment and in terms of revenues. And these losses continue to be sustained. Now, let's us move to the financial side of these firms. On the left-hand side, I essentially plot the average payment that I observed in a given month of a firm into credit cards and into loans. Okay? And that is going to be an important measure of understanding what is their dependence on these sources of financing. And what you can see is that at every point in time, credit card financing seems to occupy a much larger fraction of cash flows of the firm relative to loan servicing. Okay? This difference has increased over time. And what is very interesting is that you can essentially back out what were the balances that the direction in which balances were changing, because you can distinguish not only between payments but also usage, which is essentially expenditures. The positive difference essentially says that the law of motion dictates that you're accumulating more and more balances on your credit cards. All right? Especially in 2023, usage remained quite elevated, but payments went down, which indicates that, especially at this point, small firms started to accumulate debt in credit cards. The left-hand side now shows us something that is quite unique about the data, which is we not only that we directly can see what are the interest payments that each business do on each credit card. And here we focus on all the businesses that have positive interest payments. So approximately there is a 60-40 split in terms of revolvers versus those that accumulate balances. But what you can see here is that since 2021, there was a 60% increase in interest payments of firms in the economy. And not astonishingly, the average delinquency rates associated to the sample of firms also become higher. Now, the next step of our analysis was essentially to understand, well, what does this correspond to? So we fielded to more than 5,000 firms in the US over 6 quarters in 2023 and 2024, surveys asking them about social demographics, preferences, and shocks. Let me just summarize that we find some compelling evidence that even in the surveys, credit cards are the most used financial security by entrepreneurs, and that it broadly aligns with what we think about financial constraints: age, size, cash strapped. However, let me focus first on the following graph, because I think it really speaks to the distinct nature of credit card financing as a contingent line of financing. We essentially asked them about usage and preferences about securities. So over the last year, did the business become more or less reliant on credit cards? Okay. and that's in light gray. Preference. If your business had equal access to financing option, which would you choose first? And so what we plot in dark gray is in dark here is essentially those that put credit cards first. So we then separate their response rates according to whether or not they experienced a worsening of financial conditions. No financial worsening, financial worsening. What appears is that usage, which is 30 percentage points higher for the constrained group as opposed to the unconstrained group, is 30% higher for the constrained group, but preferences go the other way around. Okay? We then want to essentially think about this specific role that credit cards play when firms face shocks. To do so, we set up essentially what we call a pecking order specification. So we break up a firm into a firm at a quarter survey, and then according to the securities that they pay into. So the left-hand side variable is essentially the share of cash flow payments in month T allocated to security S. The securities that we think about are those that we observe best, which is cash, credit cards, and loan payments. Okay, so the question is, what do you rely most on? We then interacted with measures of firm-specific shocks that are unexpected. What are they? They relate to financial constraints, uncertainty about future cash flows, and shocks to overdue customers. Meaning that suddenly the guy that was owing you a lot of money actually still didn't pay. So we're going to essentially distinguish between the pecking order hypothesis in normal times and in crisis times, or in, let's say, shock times. So in normal times, you see that the pecking order holds pretty well. It's that internal cash is the most used financing method, followed then by credit cards, which is consistent with the aggregate evidence. Because credit cards, the share of payments to credit cards is 3.5 percentage points higher relative to loans. What happens when we look at the moment that the firm has a shock to its operation, whether it's constraints, uncertainty, or late customers? Well, in all cases, we observe that firms do not alter internal cash or payments to loans. The main adjustment margin in terms of the capital structure is going to be that they reduce payments into credit card by 3.2 percentage points. And conditional on the usage, this means that they essentially are accumulating debt. Remember the two lines that were diverging. Now, can we essentially show that this matters for the economy? Well, in order to do so, we essentially use the monetary policy shock of 2022, when policy rates went essentially from 0 to 5 percentage points in a matter of 2 years. What is going to be our kind of variation in the supply of credit card financing? Well, it's going to be the bank's exposure to this shock, which we measure through the net income gap, which is essentially the value of rate-sensitive assets minus the value of rate-sensitive liabilities scaled by total assets of an intermediary. What is the intuition? Well, it's that if you have a high income gap, it means that you have a lot of assets that are going to reprice right at the moment when policy rates are going up. At the same time, the liabilities are going to stay fixed. So these are the intermediaries that should, relatively speaking, keep supply of credit card financing relatively more open. In fact, we find, using RateWatch data, we find preliminary evidence on this, because you see that the overall increase in APRs on credit cards, which happened between January 22 and 23, well, that it was differentially executed by banks according to their exposure to the monetary policy shock. So banks with a high income gap seem to increase the APRs less so than banks with a low income gap. Okay? Then we put this into our familiar Quajan-Mian setting. We essentially use the fact that we can look and that we can identify for each account, for each credit card, who is the intermediary. And we are going to essentially use the fact that a large fraction of businesses have 2 credit cards, at least. And so what we're going to do is we're going to look at outcomes such as balances, payments, interest, and we're going to essentially be focused on the interaction between the gap and the Fed funds rate. Identification is going to be coming from the fact that we are able to control flexibly for demand shocks through time firm fixed effects, But also, I would like to emphasize that this is going to be specific to credit cards because for each firm-bank relation, we also can control for what is the loan policy and the cash that they have. So the results are presented in this table. Let me just focus on column 1, in which you have the credit card balances. So a standard deviation lower income gap, okay, so a worse exposure to the monetary policy shock of an intermediary is associated with 15% lower credit card balances, okay? And all the results are consistent in terms of the usage, the payments, and the interest accumulated, okay? Of course, we can plot this across time, and reassuringly, we see that these differences arise when the monetary policy change happens. Okay, so the traditional diff and diff graphs. But what I would like to spend a little bit more time here is essentially the fact that we can then essentially trace this change in the supply of credit card financing into real outcomes of these firms. Because in each month, we essentially observe their revenues and their employment. Again, so here we're going to fix it at the quarterly level, and we're going to look at the change in employment and the change in quarterly revenues as a function of the average income gap of the intermediaries that you're banking with. So it's a weighted average. All right? Consistent with the previous evidence, we find that, again, lower income gap intermediaries that reduce the supply of credit card financing to these firms will essentially affect business growth by reducing quarterly revenue growth rate by 2.1 percentage points. Okay? The same holds true for employment. And we also have an analysis in which we essentially show that a similar phenomenon occurs also with delinquencies. Okay? Now, in the interest of time, more or less, macro model in 1 minute. That's standard. So the model is essentially very simple. It's a setup of an infinitely lived entrepreneur with essentially 3 assets: credit cards, long-term loans, which have low APR but some fixed cost of adjustment, and liquid balances. The key friction that we want to think about is a cash-in-hand constraint. So the entrepreneur must finance labor and capital before producing. Okay? The other critical ingredient in this modeling is going to be that credit cards are going to be an imperfect substitute for cash in the production. Because credit cards can be used for financing some purchases, but for instance, you cannot pay wages with them. Right? So let me directly go to what I think is some of the most big picture implications from this analysis. First of all, this simple model, again, here we're not even going to think about default or the coexistence of liquid savings and credit card balances. Okay, so it's a very simple model, but it helps us to make a very simple decomposition in terms of trying to attribute what part of production is essentially sustained by credit card financing from other types of securities. Okay? So the output of the firm is essentially dependent on credit cards and other securities. And when we aggregate up the productivity along the productivity distribution, you can essentially obtain an aggregate estimate of the contribution of credit cards to small business activity. And we find that credit card financing contributes to 7 to 8% of quarterly small business revenues. Okay? And here is essentially the initial quotes that I presented to you from Tanya and from Judd about the benefits and the pitfalls of credit card financing for entrepreneurs, which is that we essentially plot an impulse response function in which we shock the aggregate cost of financing uniformly. We have an economy in which there are no credit cards and an economy in blue in which there are credit cards. What you see clearly is that there is a significantly less pronounced dip, which is consistent with the use of credit cards as a lifeline for businesses when there is a shock. At the same time, there are some important longer-term consequences, which mean that you accumulate high APR debt, which means that the time that it takes to go back to steady state is going to be 40% longer than in an economy without credit cards. Okay? So, thank you very much. We hope that with this new data, we were able to shed light on an important new phenomenon in small business operations, and essentially try to think about how the substantial changes in the lending relationship between intermediaries and small firms has affected the dynamism of this part of the economy. Thanks.
Thank you very much to the organizers for asking me to discuss this very interesting paper. I had a very fun time reading it and thinking about it. So I'm going to motivate it in much the same way that Nicolas did, not surprisingly, which is the importance of small and young firms for the economy's growth and dynamism. So in particular, the importance of this class of firms is really something that comes from the right tail, the kind of superstar type entrance in the economy. And some numbers that kind of help us understand this is that firms that are the youngest in the economy, so less than 5 years, account for a tiny fraction of total aggregate employment, 13%, but a substantially higher fraction, 32% of job creation. This is over the past 4 decades using BDS data. And this growth really comes as a result of what is termed in the literature up and out dynamics of entrant firms, in the sense that the majority of new firms exit very quickly within 5 years after entry. And among continuing firms, even the median firm has essentially zero growth. The job creation of young firms really comes from the superstars. So one way to see this is that the 90th percentile of firms that are less than 5 years in age have an annualized growth rate or job creation rate of 70%. And then kind of, another part of the motivation is that the growth and the selection of these entrant firms is very likely something that we would think is affected by financial frictions. So these are kind of the types of firms where issues of informational asymmetries loom large. We also have, a good amount of survey evidence on the range of external financing that entrepreneurs tap. It's things like equity off of their own home balance sheets, money from friends and family, really anything that they seem to be able to get their hands on. We also have, more rigorous kind of quasi-causal evidence that the entry rates in regions exposed to different financing conditions that you might think affect entrepreneurship, like local housing prices or the deregulation of bank credit, affects the rate of entry in those regions. And then more theoretically, entrepreneurship is kind of a classic channel by which macroeconomic shocks can be amplified and propagated. So the kind of classic, one of the first papers in this literature, Bernanke and Gertler, 1989, explicitly is modeling entrepreneurs whose net wealth is kind of persistently affected by negative shocks to the economy. And I think that this is, partly or could partly be reflected in a fact from the literature that I think has been a little bit underappreciated, which is that recessions have very persistent kind of scarring effects on businesses that enter during them. So this picture here is just one way to show this. It's from Sarah Morea's job market paper. What it's showing is the employment growth rate of firms that obviously continue to operate as a function of their age, as well as what point in the business cycle they enter at. So the red line is the trough in the business cycle and the green line is the peak. And what we see here is that, although all firms kind of experience this upward sloping profile of employment growth over their life cycle, so conditional on not exiting, firms continue to expand their employment. The firms that enter at the peak of a business cycle have a persistently higher level of employment relative to firms that enter at a trough. So this could partially be because of selection, that maybe firms that would have been the largest just aren't able to get the financing that they need to enter during the recession, or it could be kind of some causal scarring effect of the recession on the firm level itself that's inducing this. Either way, though, it seems kind of plausible to me when I look at pictures like this that financial frictions that interact with aggregate shocks could have very important and kind of durable effects on entrepreneurship and kind of the contribution of young firms to the growth that to some extent drives the economy and its innovation. I kind of am talking speculatively about this, though, because it's quite hard to get direct evidence for a broad set of young and small firms, how sensitive they are both in the short run as well as in the long run to business cycles and financial frictions. This is because to study this question, we really want data that has three features. First, we want data that contains a large and representative sample of young firms where we are not selecting on firms reaching a certain size or age. And working with census data, even kind of what I think is the best available data set that the census collects on small firms that are tied to their financing, the quarterly financial report, this is something that we usually do not have in administrative data sets because of the fact that to begin surveying a firm, the census needs to know that it exists. And so it typically needs to be in operation at least for a couple of years. And usually the minimum sizes of even kind of thinking about surveying these firms are on the order of $250,000 or so in revenue, which is far larger than kind of the average small firm in Nicolas's data set. We also want this data set to contain, comprehensive information on the different sources of financing that small entrant firms might use, because we really want to see what the marginal source of financing for these small firms is and how these marginal sources of financing are sensitive differentially to financial shocks and, different stages of the business cycle. And then finally, we want to be able to track the real outcomes of these small firms over their lifetimes. So we not only want to understand kind of, what is the effects of differential aggregate shocks on their growth rate or their sensitivity in the short run, but we also want to understand how does it affect kind of the rate of innovation and their capacity to grow large, especially for the superstar firms that I've mentioned. So what this paper brings to the table is an exciting new data set on small businesses from Intuit QuickBooks. So it seems that the authors were able to really, maneuver a quite useful partnership with this company. And having tried to get data out of companies with data sets, like this, that I assume many of us have, it is, a very important contribution in and of itself to kind of bring this new data to the table and bring it into the public sphere. So I kind of argue that this data set goes a large way towards meeting the three criteria that I just laid out. And that first off, it's a large and representative sample. There's a ton of firms in it. I might have multiplied this number by an order of 5, but let's say, around 1 million firms that are customers of Intuit, with many of these customers naturally being tiny firms that don't kind of manage or build their own enterprise software in-house. It also has, more or less comprehensive information on the sources of financing that these firms can tap, and that it's linking these firms' banks and borrowing accounts. The way that I kind of think about this is that it's kind of the equivalent to small businesses, what the Ganong and Noel JP Morgan data set is to consumers, in the sense that you're kind of tracking what's coming in and out of these small businesses' bank accounts over time. It has the benefit, though, of the fact that it's more comprehensive than data sets like that, and that it's not just one bank. You can see kind of the inflows and outflows of payments from all kind of banks that the firm might tap. It does have one kind of limitation on it, which is that for entrepreneurs, personal sources of financing, like home equity lines of credit, are kind of based off survey evidence, a pretty important form of financing. And that's kind of, I think, the big omitted thing that you aren't able to see in this data set. You see the payments, but you don't know if they're coming, from the entrepreneur's own account, I believe. And then finally, with this data set, you have the ability to track real outcomes over time. So because you kind of see, flow by flow and a description of where these flows are coming from, you can kind of separate out flows into those that are, payments from customers or from lenders. And you can also link this to survey evidence that kind of gives you some more color on exactly how the firms in the sample are kind of managing the flows that you see in the data. So I kind of look at the paper as having three main empirical findings. First one is that business credit cards seem to be a quantitatively important source of financing for the firms in the sample, in the sense that the majority of firms in the sample are actively using credit cards. They're making payments and also reporting in the survey data that they're an important source of financing. And then, as Nicolas went through, these are also instruments that are more intensively used by financially constrained firms, either in terms of firms that are small and young, which we think of as being classically more financially constrained, or firms that have just recently suffered shocks like late payments from their customers. And then the second finding is that business credit cards seem to, in kind of a meaningful sense, be a marginal source of credit following adverse shocks, which is to say they seem to provide these small firms with an important source of liquidity insurance. So one way to see this, what Nicolas went through, is that you have reduced payments into cards or run-up of business credit card account balances after adverse cash flow or uncertainty shocks to a firm. And then you also have quasi-causal evidence of the real effect of business credit cards, and that's when there's a positive shock to the supply of business credit cards from banks during the 2002-23 tightening cycle, affected firms that have experienced a more positive shock have increased card balances and improved real outcomes, so higher revenue and employment growth. And then finally, the authors kind of argue that these benefits come at an observable cost of potentially triggering kind of destabilizing dynamics. They don't use this word, but I kind of think of it as potentially triggering a levered ratchet effect, and that because of the fact that the APRs on credit cards are high and that firms that pay interest, especially during the tightening period, tend to keep on running up their balances, there's a potential that having higher card balances and relying more on them leads to kind of destabilizing run-ups in borrowing and leverage, which in the paper is associated with a higher delinquency, so a higher incidence of late payments as interest rates go up. Okay, so my kind of high-level thoughts on this are that I think it's a very cool paper. There's a lot that you can do with this data, and there's already a lot that the authors have done with it in this paper. And so I think that, in and of itself, the paper is super cool and has very novel and interesting findings. I personally learned a lot from reading it, and I also started to appreciate a little bit more some of the limitations of the data sets that I use that I previously thought were kind of more at the frontier of things, at least in the United States. So I certainly learned, how far we can kind of push this frontier with private data. So I'm going to go through, some aspects of the paper that I think can be refined or drilled down on a little bit. So the first is that conceptually, I kind of want to talk a little bit about what exactly the paper wants to capture in terms of what the economic function of business credit cards is, in terms of its role in facilitating transactions versus as a source of external financing. I also want to kind of think about a little bit what population of firms the authors kind of are arguing or want this data set to capture in terms of thinking about sort of entrepreneurs versus small businesses more generally. I then want to get into kind of, some identification concerns, quote unquote, with the estimates of the credit card based supply shock. I don't truly have a ton of concerns with how they identified those effects, but as a good discussant, I came up with some convoluted things that the authors can maybe check the robustness of their estimates with respect to. So I'll go through those. And then lastly, I'm going to go into kind of how the authors interpret and utilize their quasi-causal estimates to calibrate their quantitative model, and whether or not there are any concerns with kind of extrapolating their estimates to the structural elasticity that they use for their model. Okay, so going right into it, the first thing I want to talk about is kind of conceptually what economic function of business credit cards are. So we as we all kind of know from using them in our daily lives, credit cards can have two very different functions. The first is they can, be a source of transactional convenience as well as potentially, benefits and reward points. Or credit cards can be an expensive source of external financing that's either valuable today for a small business that has no other access to external financing, or to a small business that in some future state of the world might expect to not have access to as cheap a cost of financing. So, the lines between these two types of purposes can be kind of, blurred. Theoretically, if I'm borrowing, in the grace period in a given month, I could be using a credit card as a source of financing, even if I'm not running balances and paying interest on it. But I think in the data, there is kind of a clear distinction, or, in some other data sets, there seems to be a pretty clear distinction between firms that are using credit cards for either of these two purposes. So what I'm showing here is data from another paper that uses an alternative source of data on business credit cards. And that can, because it's based off of credit bureau reports, see the utilization rate that different firms at points in time have on their outstanding credit cards. And so what we kind of see in this distribution is there's kind of two sort of modes of utilization rates. So one, which is the majority of firms, or a good number of firms that are utilizing these credit cards, do not, at a given point in time, have any balances on their cards. So these are firms that are presumably solely using their credit cards just to make payments and nothing else. And then you have a set of firms that have a 100% utilization rate, which obviously are firms that we would think of as being financially constrained. They are, trying to borrow as much as they can using this instrument. And so it seems that for these firms, business credit cards, are a source of external financing. And, in between, it's obviously a bit less clear how you would break down these two functions. I think that something that would really help the paper is to kind of more explicitly decompose their effects and separate firms into buckets based off of which of these two purposes of using business credit cards the firms seem to be associated with. And this is kind of in two senses. So first, I think distinguishing between the types would really enrich the analysis of the time series variation and the exploration of the monetary tightening effects. So what we see in panel B, and this is a picture that Nicolas showed in his presentation, is that kind of when the credit card usage during the tightening cycle, there is this rise in balances, which is just equal to the gap between the usage rate and the payment rate. And it really materializes because of a pretty pronounced drop in payments by small businesses when rates start to go up. And so this kind of, poses the question of whether or not the fact that we see this run up in balances during the tightening is reflecting effects from the kind of extensive margin of card use. So kind of within firms that would normally rely on these cards for transaction purposes starting to revolve them. As well as, whether or not the causal effects that the authors estimate of this tightening cycle are, purely the result of kind of external financing improvements from having access to credit cards, or could also reflect kind of shocks to the transaction efficiency of using credit cards, which some work on small businesses have found to exist in other contexts. And so by kind of separating out the treatment effects into types of firms that kind of a priori seem to be more likely to use their cards for one purpose or another based off of kind of what type of balances they've run up in the past, you can kind of get a sense of where exactly the kind of effects of this tightening are coming from in terms of which of the purposes it's interfering with. And then, kind of overall in the cross section, I think that it's kind of important to kind of put a little bit of a caveat on this point that kind of credit cards seem to be a very important source of financing relative to loans, in the sense that when we're looking at credit card payments, we're kind of combining payments that are made into cards that have outstanding balances, so from firms that are actually using them as a source of financing, with payments from firms that are just using their credit card to transact each month. And so in a sense, I don't think these two lines are really apples to apples. And I think the importance of loans and credit cards is probably a little bit less stark than claimed in the paper. Okay. The other kind of thing that I think conceptually is important to flesh out a little bit is what population of firms the authors are going after. So the motivation is obviously about entrepreneurship and the growth of young firms. But a kind of first order fact about entrepreneurship, at least in the United States, is that most young firms don't actually want to grow. And so there's this kind of classic Brookings paper by Hurst and Pugsley that survey a representative sample of entrants, who find that, a minority of entrants report wanting to grow as large as they possibly can grow. And the kind of reason for this is that managers in these firms say that they founded them kind of because they wanted to be their own boss. There's some non-pecuniary benefits of running their own firm, and they don't actually really aspire to become the kind of superstar entrepreneurs that kind of, from a macroeconomics angle, I think the authors are trying to study. And a kind of useful terminology for this from Entrepreneurship is some entrepreneurs are kind of the subsistence type and others are the transformational type. It's a development context, but it kind of applies more generally, I think. So in the sample does have some very large firms, as we can kind of see in the summary stats. So, the max firm size is something like 1,000 employees or almost. That's like the size of Anthropic. But this could just reflect the, transformational type entrepreneurs that have just grown very quickly upon entering. And so it's something that, we would want to be included in the sample. But something that was a little bit, less clear to me is the fact that, at least based off of the survey data set, the sample also seems to include several mature firms. So the average age, there's a good fraction of firms that kind of have just entered, but there's also a pretty substantial fraction of firms that are very mature firms. And so it wasn't super clear to me kind of what, these firms were doing here, or whether or not there are any filters being applied to the main sample, because I don't think age was included in that previous table. Just kind of, I've already said this, but I think it would just be good for the authors to kind of, from the outset, say exactly kind of what sample of firms they're going after and kind of whether or not they're applying any filters to get it. I think that, a filter on age seems pretty sensible to me. Okay, I'm going to go through this very quickly, but the authors, do the quasi-Mian approach to try to estimate the causal effect of credit supply shocks. Just some kind of concerns or things to check on this is that, first off, when the authors run these quasi-Mian regressions, I don't believe they show the column with the same regression without the firm by quarter fixed effects. Quasi-Mian is really not about saying that you have a credit supply shock, but saying that it's okay to look at kind of firm level effects of that shock, because it doesn't seem there's a covariance between the instrument that you're using and idiosyncratic shocks to firm level loan demand. And so showing that column is kind of, I think, a standard thing to do for good reason. And then just one concern about the instrument that I'll just bring up briefly is that, they're using a very particular episode in banking history in the U.S. when there were obviously runs on certain types of banks, and where, banks with a lot of maturity mismatch on their balance sheet were quite susceptible to the rapid tightening of the Fed. One kind of possibility that I thought, which doesn't seem super unreasonable to be kind of concerned about, is that credit card specialists like Capital One and Discover might be kind of having a large influence on their estimates, in the sense that kind of credit card specialists like Capital One have low exposure to increases in interest rates, because they have a high fraction of their income from net interest income, as well as, a lot of floating rate assets. And so to the extent that you think that firms prefer to use these specialist banks to use credit cards when they have two outstanding, it would be the case that firms with high idiosyncratic credit demand during the tightening episode would prefer to borrow from specialists when rates rise, which would kind of, not be consistent with kind of the assumption being made that supply and demand shocks are unrelated with this instrument. So my kind of biggest substantive suggestion to the authors is that their data is super cool and super granular, and they can see all the payments coming into and out of the firm, and they can classify the payments into what their type is. And so in order to kind of get, I think, closer to the motivation of exactly kind of how credit card borrowing and the financial frictions that these firms face are kind of affecting the aggregate economy, the rate of innovation, and so on, I think it would be great to drill down into exactly what payment flows are being disrupted by the monetary shock and the cross-sectional incidents of it that they're identifying. So things like, what types of spending are constrained firms cutting back on? Is it inventory? Is it innovative activities? Are they investing in artificial intelligence? Then does that get disrupted? What relationships are getting disturbed? Are there any symptoms of financial distress that we can see, like late payments to suppliers? The kind of distress measure that the authors use in the paper, the kind of fraction of payments into credit cards that are late, I think is a little bit, not satisfactory in getting at the stress, in the sense that kind of, paying your credit card late and kind of accruing fees, that is just kind of another way of saying that these firms are using cards for liquidity insurance. These are high cost products, and they're just waiting to pay them back. And so I think that getting more into these types of outcome measures that kind of reflect the longer term outcomes and the hysteresis of the shock that the authors are looking at would be quite valuable. So I'm already quite over time, but just to wrap up, I think that it's a very useful paper, great data, very interesting findings. And I think that this and future papers using the Intuit data sets will go a long way to pushing the frontier of what we can study in entrepreneurship and macrofinance. Thank you.